So the authors are trying to find out what is important to investors when they are choosing a mutual fund to invest in. So the first thought is that investors likely are looking at the alphas of returns as far as which mutual funds have the highest alphas, then those should get the most money from investors. But the issue is that there are many different ways to calculate alpha based on different regressions that have been used in the past. They use different factors. For instance, the three-factor model, the four-factor model. This was Fama French, and then added the momentum. And then we have some industry factors in here as well. And then a few others that were added by Fama and French later on. So what the authors have done is taken the fund flows into mutual funds as the dependent variable of a regression and used the alphas of each of these models to which of the models best explains the flows into mutual funds. And what they found is that the CAPM alpha is the one that best explains the flows into mutual funds. And we see this first of all, the askers say that these coefficients, these alpha coefficients, are significant at the 1% level, but also that the coefficient is so much bigger than the coefficients of the other models. So if the CAPM alpha increases by 1%, then the flows into mutual funds increase by 0.474% each month. So next, the authors have isolated just the 7-factor model and regressed against the fund flows to see which factors actually explain the flows into the mutual funds. So the 7-factor model is basically made up of an alpha, an intercept, the market return, which is basically the market minus the risk-free rate, and then we've got a size, value, and momentum factors, and 3 industry factors. So the thought is that a sophisticated investor, when he or she selects a mutual fund to invest in, he or she should choose the one that obtains returns that can't be explained by certain factors that are already known to explain significant returns, mostly based on risk. So an investor should ignore the factor-related returns based on size, value, market, momentum, industry returns, and decide on the investment to make based on the alpha, which is the returns that can't be explained by the other factors. So as an example, historically, value stocks have outperformed growth stocks over certain periods of time. So if an investor were to evaluate a mutual fund that is value focused, then it wouldn't really make sense to compare the returns of that value portfolio to maybe returns of a growth portfolio. You would basically have to control for the differences between the value and the growth portfolio, and that way you're comparing apples to apples, and would even give you the ability to compare the returns of one value manager to the returns of another value manager, or to compare against a growth manager. So in that way, a sophisticated investor, when he's making a decision of what mutual fund to invest in, shouldn't really consider he should consider which factors are composed of, but only to back out those returns in favor of, to see what did the investment manager earn after controlling for all of these different factors, and that's found in the alpha. But interestingly, what we found in this particular, the 7-factor model, is that all of these factors exhibit positive coefficients. Most of them actually are significant at the 1% level as well. So we can see that investors aren't necessarily backing out these returns when they're making decisions of which mutual funds to get into. And in connection with that, we note that the smallest coefficient here is the market return, and that kind of fits in with what we saw in the prior table with the cap M, because we found the market return portion of the cap M to not be significant and only the alpha. So we can say that maybe investors consider the market return when they're trying to control the returns and compare different mutual funds, but they don't control for these other factors adequately enough. So next, the authors considered that maybe more sophisticated investors may not rely on the factors as much as less sophisticated investors do. And so to find that out, they looked at investors who buy mutual funds directly from the fund or from brokers, say for instance Edward Jones or someone. So the more sophisticated investor would probably buy directly from the fund, and less sophisticated maybe from a broker. They also looked at periods of high and low sentiment, where there were high fund flows and low flow funds, and then also really wealthy investors versus other investors, with the presumption that wealthy investors are more sophisticated than other investors. And so what they found is what they expected, that the presumed unsophisticated investors, the ones that bought from the broker or during high sentiment, or non-wealthy investors, tended to cause higher fund flows when these factor-related returns were higher, because we can see in this column the difference. That would be the difference between the unsophisticated and the sophisticated investors, where we see that, for instance, the size-based return factor coefficient is higher for the unsophisticated investor than the sophisticated investor. So the unsophisticated investor is likely not controlling for the size returns as much as maybe the sophisticated investor is. And interesting to see, especially when we look at these two columns here for the sentiment and level of wealth, the difference in the market return coefficient is insignificant, or less significant than the other factors, as is momentum. So we could say that even the unsophisticated investors usually back out or control for the market return when assessing how great a fund manager is.